Hello again. I'm here with Manuel Kalbreier of Neuberger, Berman, and he's head of specialist alternatives. Manuel, very nice to have you.
Nice to be here, thank you.
Please introduce yourself and your firm and your role.
Yes, of course, with pleasure. Neuberger Berman is a global asset manager headquartered in New York. We manage about $560 billion across public equity, public fixed income, and alternatives. So alternatives for us is about 160 billion in private markets across private equity, private debt, private infrastructure, and private real estate. My role is very straightforward. I'm really the linchpin between our client-facing team and our investment teams on the private markets. So our private markets investment teams are really specialized along different strategies, although they all work together. And I bring this entire private markets platform to our clients.
We're here to talk about evergreen funds. And how are these funds and technology together changing the way that private wealth and retail investors access private markets?
So there's an important distinction, obviously, when we talk about evergreen funds, because evergreen funds are accessed both by institutional investors as well as individual investors, and that's sort of slightly different ecosystem. But looking at the ecosystem for individual investors, more specifically when we talk about evergreen funds, what's really evolved is that we've adapted this ecosystem along a couple of lines. First of all, the technology access is really about delivering an individual client experience that's very similar to what we see in the public markets, such as monthly reporting, transparencies, monthly NAVs, etc. That's largely solvable through technology. But I would say that the two other aspects that are very important are obviously the access to high quality investments on the private side. So really delivering a platform that gives institutional quality investments in private markets to individual investors. And then the last point is that about liquidity and providing an ease of access through liquidity.
Can you explain Neuberger Berman's liquidity philosophy in relation to evergreen funds?
Yeah, so I think the real starting point, and it's a very important question, is about matching the liquidity with the underlying assets. So the liquidity aspect concerns two sides of the evergreen vehicle, the investment side and the redemption side from a client's point of view. So giving liquidity access is very important because unlike in the closed-end fund world where you're making a commitment and then that gets drawn over time, the individual investors want liquidity of access, i.e. they want to be able to make an investment and then that investment being deployed at the next monthly or quarterly NAV. In order to manage that access of liquidity, it's very much about having a deep bench of investments that we can execute as inflows come in. On the exit side, obviously, you want to manage the liquidity of your evergreen vehicle so that it fits the liquidity of your underlying investments. And therefore, it's important to build a portfolio that's diversified by underlying investments as well as by vintages so that you create natural liquidity in the evergreen vehicle itself. Okay. The cash buffer then really is a way to ease this liquidity, but the core is really about building a portfolio that has natural exit liquidity.
I have to say, it sounds a little complicated. What's the optimal liquidity experience for the private clients?
So I think the optimal liquidity experience for private clients is really one where the liquidity is matching the underlying assets liquidity. Mm-hmm. So what it means is effectively communicating very clearly to individual clients about what kind of assets this evergreen fund is investing. Is it a private debt asset that has maybe a natural maturity after 3 years or 5 years or 18 months? That has a certain liquidity profile. Or is it a private equity investment that has a liquidity that could be in 4, 5, 6 years? And so ultimately, the first step around liquidity is really communicating that clearly and then explaining in which circumstances that liquidity could be different.
A lot of people say that evergreens open private markets to retail investors. Why exactly is that?
I think that when an individual investor invests in private markets, the difficulty was closed-end vehicles, which has been the traditional access way, and this is sort of how this access started through feeders into closed-end vehicles, is that unless you have a very, very broad portfolio where you can really schedule your different commitments in closed-end funds, it's very hard to have an optimal portfolio that doesn't have a very big cash drag because when you're committing to a closed-end fund, you have to have the money available when that money gets called. And therefore, the evergreen vehicle is a really good solution for an individual client to be able to gain access without the difficulties of closed-end funds. But beyond that, I think sort of taking a step back, what we are seeing sort of more holistically is a relatively simple fact. When my father started working at age 27, he knew that by age 67, he would receive a pension that was equivalent of a certain percentage of his final salary, and he never had to worry about this ever again. When I started working, my employer basically said, here is some money in an account every month, you deal with your pension. So at the end of the day, the problem is the same, just in one case, my father's employer was worrying about how to invest in the long term. In my case, I have to worry about that. But the need for long-term assets is exactly the same, just in one case, it's in the individual's hands. So the evergreen vehicles are really a good way to offer access to long-term assets for pensions.
How do you work with banks and other intermediaries to get these private investors to invest into your vehicle? How does it work?
When we work with banks and other intermediaries, the approach to private markets is quite different than from an institutional point of view. Banks and intermediaries are looking for the same quality, institutional quality of underlying investments, but they're looking for a couple of other things. First of all, they're looking for diversification. Ultimately, individual clients are not going to have as broad a diversification in terms of funds allocation than an institutional would have. So at the core, we offer evergreen vehicles that offer broad diversification across transactions, vintages, etc. The second point is there has to be a very efficient fee structure, because the risk is obviously that if the fee structure is too high with several layers of fees, then the performance experience becomes deteriorated, and that's an important factor to take into account. And then the last point is really about the delivery. And so the delivery could be either having the right vehicle, whether it's an LTIF 2.0 evergreen vehicle, or creating white label solutions where we really provide the investment capability, but the vehicle is owned by the distributors. We have experience in all of these channels.
Okay, sounds great. Sounds very interesting. The future of private wealth investment.
We think so.
Thank you, Manuel.
Thank you.